Hello, and welcome to the mid-year outlook from Capital Stewards. Despite higher index levels, we continue to see a lot of volatility in markets, and that continues to weigh on the minds of many of our clients and friends. So in this outlook, we're going to talk through some of the biggest concerns that I'm hearing from investors over the summer. Questions like, is the AI story still real? What's going on with chips? Are we moving into bubble territory, or are we about to go, off the cliff, so to speak? Many folks are wondering if they're too concentrated in the tech industry and what they should do to help mitigate the risk of big downward moves. We'll talk about building diversified portfolios a little bit. Inflation's back at sort of near-term highs, right? We've come down from the high, but we've seen a little bit of a spike recently. So what can we expect there for the rest of the year? And then what does the new Fed chair mean for markets and for portfolios? So those are just a few of the questions that I've heard folks asking as we head into the second half of the year. As always, I'll start by laying out my views on the economy, and then we'll get through investing in various assets like stocks, gold, bonds, real estate, et cetera, based on where the world and the economy sits at the moment. So as usual, these Outlook episodes are a little bit longer. I know you'll probably want to listen to the whole thing, but in case you're looking for something specific, check the notes. You can skip ahead to the different topics that I talk through. There's lots of charts in this episode, so if you're listening to the podcast version, think about watching on YouTube so you can see all the charts. All right, so let's dive in. Let's start with what's happened so far this year. On the chart, you can see the S&P 500 stock index in the red line. The index was flat for most of the first quarter leading up to the war. We had concerns about AI's impact on technology. If you remember all of that, investors were shifting from sort of growth stocks like the Mag 7 into other areas of the market that caused the index to kind of flatline. Then the war began at the end of February, and you can see the market decline more than 9% before rallying back through most of the second quarter, and it's now up about 10% for the year. So almost a 20% swing so far this year, lots of volatility. In developed Asia, Europe, Australia, that's the blue line. Those markets have seen similar performance to the US, up just under 10% for the year. Emerging markets, been one of our key themes, that's continue to outperform both sets of developed markets and the US as well, and that's up 24% so far for the year. So bonds in the purple line, they're essentially flat for the year. We've seen rates rise as oil prices have risen. Gold, after a strong run over the last 3 years and really strong to start the year, was down sharply in Q2, and now it's down about 7% so far for the year. So looking at long-term returns, that's what helps us stay focused, right, on what matters during these times of volatility when we see all of this back and forth. When we look back over the last 30 years, we have the tech bust, we have the financial crisis, COVID, war in Iran. Through all of that, the S&P 500 has returned almost 10% on average each year. Bonds have averaged 4%. Inflation still only averaging 2.6%, and gold's returned just over 9% each year. So when we zoom in over the last decade, over the last 10 years, despite COVID, the sell-off in 2022, rising inflation, all the bad stuff, we still see strong asset returns. The S&P 500 stocks are averaging 15% each year, followed by gold at 11%. Bonds have returned 1.7%, and inflation's averaged 3.2%. So when you think about the really long term, that 30-year and the 10-year history, you'd be a very happy investor today if you had invested in the peak of markets before the global financial crisis or right before COVID. During our last outlook, in the heat of the Iran conflict, we talked about how important it was to stay the course through geopolitical uncertainty. And you can see now why that's so important. That doesn't mean that we just blindly throw money into the stock market or any other asset. Properly building a portfolio will help you sort of reduce risk, earn the returns you need to accomplish your goals, and smooth the ride out, reduce that volatility along the way. So we'll talk more about changes you should be making or thinking about making in portfolios as we go. But you should feel confident in sticking with your investment plan in both down markets and in up markets, because that's how you generate those long-term returns. And if you have concerns and you think, hey, I might not stick with this if we go through something more challenging in the second half of the year, then it's probably time to seek out new professional advice. So before we move into the economy, let's talk briefly about what's going on in Iran. That's going to be really important as we get into the second half. Since the announcement of the ceasefire, my expectation has been that the sort of the deal will look similar to kind of the current status quo, which is a lot of kick the can by both sides. The Iranian government is ideological. They believe that they're doing the right thing to spread their religious views, eliminate Israel, fight the West, all of those things. And they're willing to do that at almost any cost. History has shown that. So I think it's dangerous to assume that they're going to bargain away all of their power over a 30-day oil embargo. From the U.S. perspective, the strikes over the first part of the operation did degrade Iran's military threat pretty significantly. That doesn't mean it's zero, right? But we certainly took out a lot of stuff, right? And frankly, the U.S. has probably accomplished all it really wants to accomplish by hurting Iran's ability to attack its neighbors in Israel. Again, not eliminated, but they certainly degraded it a lot. Facilitating regime change in Iran is going to cost a lot of American lives and money, and I don't think there's the political will to do that kind of operation. And so the Iranians want to persist in some way, and the US is probably happy with status quo as long as the Strait of Hormuz is open for business. And so it seems like the deal is really a lot of can kicking, and the situation kind of remains like it is now. A little bit of turmoil, but largely oil flowing through the strait, that kind of thing. The two sides simply agree to stop fighting for now. I think it's unlikely that the U.S. is going to get much in the way of nuclear concessions. So eventually we probably just get a repeat of the operation that we saw in the spring down the road. We just sort of do it again. That's probably what the future holds here. In our last outlook, we talked about the expectation for oil prices to fall back into the $80 range. We've talked about this before. The world has plenty of oil. The price before the conflict was in the mid 60s, so it's probably going to remain above that, right, for some time. Markets are going to price in a little bit of a risk premium for potential future conflicts when Iran, rebuilds its capabilities. Over a couple of years, that risk premium probably evaporates because what's going to happen is that other countries in the Middle East are going to build export facilities that don't use the Strait of Hormuz, right? So Iran also, kind of in a strange way, is incentivized to make a deal here because their negotiating leverage goes down significantly over time because people will just stop using the strait, right? And then Iran has nothing really left from a global economic standpoint. So my expectation, again, is that oil prices stay sort of close to the current levels. That's going to help U.S. consumers and the economy at large moving forward. But obviously, the risk there is that if we do get some sort of significant escalation, more than just the sort of ping pong back and forth for a few days, that could change things pretty significantly. All right, so let's look at the economy. You can see on the first chart, real GDP, that's the broadest measure of economic growth, was growing about 2% last quarter. The Atlanta Fed GDP Now tracker is showing GDP growing at 2.5%, but the Atlanta Fed tracker was north of 4% for parts of the first quarter, and the final number came in at 2.7%. So it's likely that that number is going to continue to come down over time. GDP has been fluctuating with import and export volatility a lot since the tariff announcements last year. So I find it helpful to look at a line item in the GDP report called real final sales to domestic purchasers. In other words, how much stuff did U.S. folks buy? And the answer was about 2.5% more than last year. So that's pretty good. So we're growing in the low 2% range. The challenge is when we exclude the government, that drops to 1.7%. Then we remove the AI CapEx line items. That added between 1 and 2%, depending on exactly what you consider AI related. That means without the AI boom, we would have an economy with very little or any growth. So we continue to see growth, but it's very narrow growth tied to a few sectors in the economy. And that was essentially our outlook coming into the year. So not much has really changed there. When we look at consumers, we continue to see similar sort of weak but hanging in there story, right? You can see in the chart retail sales growth was about 7%, but a lot of that over the past quarter was just higher gas prices in April and May, right? Those are thankfully starting to come down. So again, this is an area where the outlook is unchanged. The K-shaped economy is becoming even more prevalent. That means the top income earners and asset holders, they continue to thrive, right? Their stock portfolios are going up and they're going to spend more money. But the remainder of the population is kind of struggling, right, with higher prices. And we're starting to see signs of that, I think, in consumer spending, right? Airline prices are up, but the number of tickets purchased is trending down. The same is true with restaurants, right? Spending is up in nominal terms because of inflation, but the number of visits is down, right? So the majority of consumers are curbing their spending. They're being more choosy in the face of higher prices. That's not to be dour about the consumer. The high end is holding in well. It's supporting spending growth. The wealth effect is helping older and wealthier consumers have more assets than they ever thought they would have. So they're spending more. That's supporting the economy. So again, a narrow slice of the economic pie is sort of holding things together. And I've shown this chart before, prices are up since COVID, but earnings and income are also up, more than enough across the country to compensate for those higher prices. And so I think people miss that, right? We feel those higher prices, but we forget that our compensation is actually higher probably too. It doesn't mean people like paying more, but they do have the resources to support those higher prices. And like I said, the reason folks aren't happy is because we're used to what's called real income growth, meaning that our incomes grow faster than costs go up each year. In this chart, you can see prior to 2020 and prior to COVID, real incomes generally grew about 2.5% a year. So people felt better off each year. Their money went further. In the aftermath of COVID, we pumped all that money into the economy to support growth. You see all the volatility, but as that stimulus has died off, especially with higher oil prices this year, income growth relative to inflation is almost zero, right? So instead of feeling richer every single year, we actually feel like we're just sort of making ends meet and getting by. And that's a big change in the way that most of us are accustomed to feeling, certainly over the last 20 or 30 years. So we should get some recovery going into the second half. Lower oil prices will help. But that's why I think a lot of the country feels really negative about the economy is because of that the difference between their sort of what's happening in their wallet and what's happening in prices and sort of the inability to get that real income growth over time. On the employment front, the jobs market continues to produce just about enough jobs every month to keep everybody employed and not much more than that. You can see in my favorite employment situation chart, the job openings in the red line, the total number of unemployed workers in the green line. Post-COVID, you see that big gap with the number of available jobs much higher than the number of unemployed workers. That causes wages to rise, right? People get paid more because there's a lot of demand for people to work. That also contributes to inflation. Now, those two lines have largely normalized, and the number of open jobs is only slightly higher than the number of workers that are looking for jobs. So importantly, the line at the bottom, we haven't seen a material uptick in layoffs, right? And that's really necessary for us to have a really bad economic outcome or to have a recession. We've seen in the jobs report so far this year, it's kind of a declining labor force. So not a super strong, sort of a job impulse, right? People aren't finding jobs. So a lot of people they're sort of stopping their search, their job search. You can see the decline there in the labor force chart. So there's probably more people that want jobs than show up in the survey. So the labor market may be a little bit weaker than meets the eye. I think, again, that's probably also confirmed by what we see in wage and salary data. The wages salary growing by about 3.5% over the past year, which that sounds healthy, but I'll remind you, it's less than inflation in the current environment. So the job market, again, not bad, not terrible, but sort of just enough, just getting by, right? And I think that's how you kind of have to think about it through the rest of the year. Importantly, we'll talk more about inflation, but the job market's not really a big driver of inflation at this point. On the inflation front, you see in the next chart, inflation settling down from its post-COVID high and going into the Iran war. And then you see the move upward as energy prices spiked earlier this year. Now, core PCE, that's the measure the Fed uses for inflation targeting. So you hear that 2%. That's what they're measuring as core PCE. That's sitting about 3.4%, so above the 2% target. However, most of that oil-related spike, I think, is going to fade in the months ahead. As oil prices move lower, core inflation is supposed to remove the direct impact of food and energy price shocks. However, we know that you need diesel to drive a truck that takes things like apparel to the store, right? So nothing is truly immune from the impact of energy. Prior academic studies show that we see the impact of higher energy prices seep into core inflation, and then actually takes a little bit of time for that impact to unwind. So in addition to the energy impact, we also know that rents and home prices are not moving higher, right? That's a big part of the inflation basket. The Case-Shiller Home Price Index is up about 1% for the year. Rents are essentially flat. Even Zillow's predicting pretty weak rent growth through the balance of the year. So, that big part of the market, the rental market, is just not going to be a big inflation impulse going forward. New vehicle prices, they're up 1.2% year over year. The Manheim Index, which measures used car prices, projected to rise about 2% in total by the end of the year. So you just don't see this group of items that are rising really fast to have a big impact on inflation to drive inflation as we get into the second half of the year. I hear a lot about chips, right? Hey, the price of computers and the price of computer chips. The problem is they're just a pretty small part of the economy. There's chips that are really valuable and they're really expensive and the prices are certainly going up. But you're talking about a basis points, right? Hundreds of 1% or tenths of 1% that they're adding to the inflation number. So without the job market getting really tight, without cars, without the housing market, without wages really pushing things, it's really hard to have an environment where you see inflation move materially higher as we go through the back half of the year. And so that's our expectations, that we're going to see inflation falling as energy prices move lower. And I think we've talked a lot about the narrowness, right? I think the narrow recipe can continue. And I expect it's going to continue for a few more months until rates start to normalize and move lower into the back half of the year. Lower rates should help us get the broader economy that a lot of folks have been calling for over the past year. The geopolitical situation just hasn't supported that yet, and so we haven't seen that. But now perhaps we can move in that direction as oil prices and rates move lower. So what does all this mean for investment assets? Let's start with the U.S. stock market, since that usually the largest part of portfolios. I get a lot of questions about some form of the word bubble. Bubbles and manias occur when investors get overconfident about the future and they bid up prices for assets relative to their underlying value or their cash flows. Pretty straightforward stuff, right? If it's too expensive, it's a bubble. When we started the year, the S&P 500 index was expected to have earnings about $310 per share. Since then, earnings expectations have increased to just north of $340 per share, and they're moving higher as companies start reporting here in the second half. They report their second quarter results. That's about a 10% jump in earnings expectations or profitability of companies. And unsurprisingly, the S&P 500 is up a little less than 10% so far this year, right? So when you just kind of boil it down and think about it more simply, that's kind of what you expect to see over the long term. You can see in the next chart, US large company stocks grow in line with earnings over the long term. Over the past year, earnings growth has actually exceeded the price growth that we've seen in markets. At the beginning of the year, the index was trading about 22 times forward earnings. That means if we continued to earn the same amount of money for the next 22 years, we would pay for we could own all the stocks in the index, right? Now that multiple is closer to 20 times earnings. So the price to buy stocks relative to earnings has actually come down. So you can have whatever perspective you want on the market, but it's simply not true that the market is in a bubble. It's certainly not more of a bubble now than it was at the beginning of the year. 20 times earnings is only slightly above the long-term average of 18. I mentioned that before. So I get concerned when multiples cross the 25 or 25 times earnings range, move closer to 30. But until then, my view is that we have plenty of room to run for stocks. There's plenty of room for them to increase in price. We just need the geopolitical environment to settle down a little bit. You also might think, well, what if those analyst expectations were wrong? What if they're too bullish? We've been through all the Q1 earnings cycle now, and if anything, the analysts were too conservative in their expectations. So again, I think we have more room here to run. Let's talk about broadening a little bit. This is a big theme I hear on we'll call it the morning market talk shows. Is the rally in growth stocks over? Is it time to move on to other areas of the market? A lot of that depends on what your definition of is, or in this case, what's been driving the market. When we look at the charts, you can see clearly that growth continues to outperform value. Growth was up 11.7% at the end of the second quarter. Value stocks only up 7.8%. So the narrow economy continues to favor companies that are growing and taking share versus the broad cyclicals like the banks and oil companies. And you can also see that the equal weighted S&P 500 index that did actually outperform growth slightly in the quarter after it lagged for several years. The reason for that is the line at the bottom of the chart. Those Mag 7 names are actually negative as a group so far this year. So what's been working is less the Mag 7 hyperscalers from the last 2 years and more the chip names like Broadcom and Micron and AMD. So are large caps broadening out? Well, if you've only owned 7 names, then yeah, that's true. The market is getting broader. But for growth investors or investors writ large, growth is still the place to be. Outside the tech sector, the outperformance has been industrials, which again are tied to the AI capex build out. Caterpillar, Eaton, Cummins engines, making generators, right? So the economy and the investing landscape is still very focused or perhaps only focused on AI, but the focus areas have shifted from the hyperscalers, to other areas of the value chain. So it's important that when you think about, we talk a lot about growth investing and we have for the last couple of years, but that doesn't mean we just own 7 or 8 stocks, right? So my view continues to be that like historical data shows, slow, narrow economic growth calls for growth investing over value. The other broadening that we've seen is outperformance of small caps versus large cap companies. Small caps have been one of 2026's quieter surprises, with the Russell 2000 up 22%. It's on pace for its best first half since 1990. The more important story there sits kind of beneath the price, though. When the year began, analysts expected small cap earnings to grow north of 20% in 2026. That figure has been revised up, but what's telling is that the revenue expectations for small cap stocks have barely budged. The gap is the whole story. This isn't a top line economic growth driven boom. It's a margin and interest rate story. Lower interest expense on the floating rate debt side, which most small cap companies have. They got a bunch of new tax incentives for equipment spending, and a cohort of AI infrastructure suppliers did a lot of that heavy lifting on profits in the first half of the year. So if we get lower rates in the second half of the year, I think that will be good for small caps, but I would not expect just a repeat performance of what we saw in the first half of the year. We've got to get rates down in the second half of the year. But again, we favor, growth over value. We still think owning small cap companies makes sense. We've owned those in more aggressive portfolios to start the year. And I think it still makes sense to do that as we move into the second half of the year. But I wouldn't expect a repeat of the gains as we go to the second half. Looking outside the U.S., international exposure has been a consistent theme now for several quarters. I expect that to continue. After more than a decade in which owning pretty much anything outside the U.S. felt like a drag, 2025 delivered a pretty good reversal, right? Developed international stocks returned roughly 32%, emerging markets about 34%. The S&P 500, good year last year, gained 17%, but there was a rare double-digit performance gap between the U.S. and the rest of the world. That momentum has carried into 2026. Developed international up, basically even with the S&P 500 through late June, and emerging markets up 24% as we closed out the second quarter. So in developed markets, The economic backdrop's kind of improving off a low base, right? Europe's leaning on fiscal stimulus, particularly German infrastructure and defense spending. The European Central Bank keeps cutting rates against, inflation that kind of continues to disappoint there. And the consensus across most professional investors, at least, is that you're going to get more fiscal impulse, more spending out of Europe. That's going to be a good thing for the big industrial economies in Europe. Japan, obviously a pretty compelling, structural story as well, right? We got the end of negative interest rates in Japan. We've got a lot of corporate governance sort of reforms, and I won't get into a ton of that on the podcast, but basically just think of that as them giving more cash back to shareholders. As shareholders, we like more cash, right? And then we've got a pretty growth-oriented prime minister and administration in Japan. So I think you kind of combine some spending in Europe from the governments, and then you get a good restructuring situation in Japan. You can have good economic growth outside the U.S., especially if we get a normalization of oil prices, because oil prices hurt those economies a lot more. They are generally oil importers, net importers, right? The U.S. negative, in whole, the U.S. is a oil exporter, right? We export more than we import, but those countries are definitely importers. So we need oil prices lower for international markets to continue to do well. And then we also think we're going to get a depreciation of the dollar. Again, this goes back to the Iran story. We need that conflict to die out a little bit, and then that should continue to drive international stocks higher. Emerging markets, again, a big part of the portfolio. Really we get lower interest rates in emerging markets. We have healthier government balance sheets. We have better governance. This is not the emerging markets of the early 2000s. And we get earnings expectations growing faster, right? JP Morgan's estimating EM earnings to grow nearly 30%, 29% for 2026. And increasingly, emerging markets are also an AI story, right? South Korea, Taiwan, and we've seen some wobble there over the summer, some volatility, but they've had huge runs the first half of the year. They supply a lot of the AI chips. You can't have an AI revolution without some of these emerging markets. So we continue to expect that emerging markets will do well as we go through the second half of 2026. Let's shift kind of the focus outside of stocks and talk a little bit about diversifying assets in portfolios. So stocks, where a lot of the growth comes from in your portfolio, but then we've got to think about what assets do we put in there to diversify when stocks don't work, right? When markets go down. So fixed income, a big part of that. It kind of took the long way around in the first half of 2026. The year opened with markets convinced the Federal Reserve, soon to be led by new Chair Kevin Warsh, would keep cutting rates. Treasury yields fell to their lows so far the year by late February, with the 10-year down about 3.95%. Then the Middle East conflict happened, sent oil sharply higher. Core inflation ticked back up, when the market kind of priced all those cuts out, and actually at one point was assigning the odds of a couple of rate hikes by the Fed. By late May, the 10-year had backed all the way up to roughly 4.7%. That's the high for the year, and then it's eased a little bit as we've come into the summer. So that round trip left kind of three marks, right? We've got higher all-in yields in the fixed income space, so better income for new money that's going in there. We've got a yield curve that has steepened, right? So that means we get to more money for investing in longer term securities. Then we get corporate credit. Those spreads have gone back down, right? So again, near multi-decade lows in the corporate credit market. So what we've done from a fixed income perspective is, for a lot of folks, we were, kind of cautious on longer term fixed income and bonds coming into the year. And then we've used this backup in yields to invest in more corporate credit, more longer term securities, now that we think yields are a little bit more fairly valued. And then if we're right, as we go through the second half of the year, if we think oil drifts lower, we have that soft labor market that pulls inflation down, then yields, real yields, all of that should fall, and the Fed regains a little bit of room to ease. I don't know if we'll get rate cuts this year, but we certainly shouldn't get hikes. That's definitely our perspective, and the market is expecting hikes. So that acts like it's sort of a rate cut when we think about investing in bonds. The same kind of tug of war explains what happens to gold. We've held that for 3 years, and that detracted from performance this quarter. After setting kind of all-time highs near 5,500 in late January, gold corrected in March and has drifted down to roughly $4,000, about 25% below its peak. The culprits were precisely the things we talked about above: rising yields, firmer dollar, higher oil, all things associated with Iran. And then you have a hawkish kind of Fed that's talking about, hey, raising rates, and that doesn't do good things for gold either, because gold doesn't pay interest payments every month, right? So, however, for those of you that have been watching this and kind of following along over time, the structural case for gold we think is still intact, right? Central banks, we've been owners of gold because central banks started buying gold, not because we're sort of gold bugs and we think great things are going to happen in the gold market. Central banks bought a record of 1,200 tons in 2025. We think they're going to add 750 to 850 tons this year. Fiscal deficits are gonna continue to feed sort of the debasement trade or the decline of currencies around the world, right? Because governments just continue to spend. So gold is only about, it's less than like 0.2% of U.S. private financial portfolio. So there's not a lot of gold ownership out there still. And we think gold, as interest rates fall, as oil prices come down, as the dollar comes down, gold can do well going into the back half of the year. So emerging market bonds, right? A little bit of a happier story when you think about diversification. They're kind of the mirror image of the headwinds. Emerging market debt was a standout in 2025. Local currency bonds did extraordinarily well, right? And emerging market bonds have done well this year. So when you think about investing in fixed income, you think about diversification, don't just think about US and US companies, but also think about bonds from economies around the world. In emerging markets, you're going to get 7% a year in yield, right? Versus call it 4% on the US side, right? So you're earning quite a spread. And, emerging market government bonds, the debt to GDP ratio is like half of that of the US, right? So there's not really a lot of fiscal risk there. It's more of a currency issue. You've got to expect that the dollar is not going to appreciate in a really significant way. So continue to like emerging market debt as a diversifier as well. So kind of to wrap up, the Iran conflict has added a lot of uncertainty, but I think the bigger takeaway is that markets and economies, they have a long history of working through shocks, and investors do best when they stay anchored to well-built, diversified plans, right? My base case is a soft but kind of stable U.S. economy as we go into the second half of the year. Inflation should ease as the oil spike fades, and market leadership is probably going to reward broader diversification, right, including international exposure. Gold kind of serving as that useful hedge, fixed income improving as growth cools. So a few practical steps for investors. I would, rebalance, right? Trim your tech exposure if it's too large after the spring run up. You want to add to what's lagged in your target allocations. Keep equity exposure diversified, right? Include the Max 7 certainly, but we also want to have smaller companies, definitely international stocks as well. You want to add longer term bonds to your portfolio. If you've been holding too much cash, this is a great opportunity to do that. And then use real assets thoughtfully, right? Gold is diversification, real estate, where you can get real estate with prices that are reflective of today's rate environment, that can be a good trade. And, if the environment is kind of like, I say this a lot, but if this environment is keeping you up at night, then that's a prompt that you need to get another opinion on your investment approach. You need to do something that you can stick with over time. It should not be keeping you up at night because you should be earning consistent returns that are going to give you confidence that you're going to achieve your goals from an investment standpoint. So that's all for now. We'll be back later this summer, and we will see you on the next episode of the Capital Stewards Podcast.